right, so just a reminder, hopefully everyone has signed up for the test this Friday. You can take it, of course, I think I let pretty much any time this week, but by Friday you must take the test. Again, we always have, I guess, the buyer beware kind of philosophy, is that if you wait to the last minute and things break down, you take all the risk associated with that. Okay, so you have multiple days in which to take it. If you wait until Friday and your power goes out, whatever the reason is, you take that chance. So please appropriate your risk accordingly. So my suggestion would be to schedule it Thursday night. That way, if things don't work out on Thursday night, you always have Friday night to take it. Don't wait until the last minute. Again, please go through the Examity instructions to make sure your computer is accessible, because they will kick you out if you don't have the right computer. That is what you need to make sure you do before you go and take your exam, is to go through and make sure that you have the right equipment. The equipment is exactly the same. It's on the syllabus that's required for this class. That's where those standards come from. Those are the Examity standards. So please make sure you do that. I feel for you when you send me those emails, but there's nothing I can do. I've told you ahead of time, and I have to go with what I tell people. That's the only fair way to do it. Yes, you should still be able to use the library, Galib. If you can use it, my suggestion would be to use it. I don't know what times they have available. Again, I sent the link. I will send the other link out today to make sure you have the link to how to reserve room to the library. But please do that. That's a good suggestion, because their internet always works, and if their internet doesn't work, then we have an issue. So yes, that's why they use Examity in the library. The rooms are easier to do. They won't give you any headache. If you don't like people from other, I don't really like people seeing into my rooms. If you notice, almost always I give my lectures, unless it's a snow day, in a classroom, an actual classroom on campus. That's a personal factor of myself. To each their own, so you have to get into a quiet room, and that's why I would use the library if it was me. But you're always free to use whatever you're most comfortable using. So please, I guess, plan accordingly. So if you're going to use the library, make sure you get the library room assigned before you assign Examity. So there's an order to that. Reserve the library at our university, then reserve your Examity time. And those should hopefully work. Again, our test should only take about an hour. You have 50 minutes of actual test time, but there is the setup from Examity that takes somewhere between 5-15 minutes, depending on the individual. It's not supposed to take more than 15 minutes, but again, I'm not in control there, and I apologize if it does. So hopefully that kind of gives you an idea of what you should do for the test, at least on that part. Today we'll finish chapter 16, and on Wednesday will be a review day. Bring your questions. That session only works if you have questions. If you don't have questions, that session's pretty boring. I will do some, but I'm not going to do a whole lot. It's a chance for you to ask what you didn't understand. But Dr. Walsh, I was doing quiz 15B, and I just did not get question 8. Here's question 8 that I did not get. Cut and paste and send it to me, or put it in the chat, and I'll work it and say, here's where it is. Here's where people I know make mistakes at. Here's how you get the correct answer. I try to give you both. So if you made a mistake, we'll talk about it then, and hopefully how we correct it. Because I want you to get the right answers. So I have the questions available. Work through the practice test. If you have not, always work through the practice test. It's a good indication of what the test will look like, at least based on chapter formation. So you can see how many questions I'm going to ask from chapter 10. I'm even going to ask for chapter 11. And the real test is a very, very similar makeup to that, at least on question format. All right, so if there's no other questions, then we will start today, and we will go through and finish chapter 16 and finish our discussion of money. All right, so we're going to talk about money in the U.S. economy. When we talk about money, there is two major things that when we talk as economists about money. When students think about money, they almost only think about this first part, is they only think about currency. That's paper bills in the hands of the non-bank public. So that's how much currency is outstanding. Okay, so when you think of money, usually this is what most students think of money. That is probably only about a third of what actually we consider money. So money is not only currency, but it also is what we call demand deposits. And what are demand deposits? These are balances in banks that depositors can access on demand by writing a check. So these are really checking accounts. So a lot of when we think about money, okay, a lot of times when economists talk about money, we talk not only about currency, but we also talk about demand deposits. And in fact, we even talk about more than that. There is two major classifications between money. So M1 is what we consider to be the most liquid money available. Easiest spent to cash. That's the easiest thing I can take and transfer into goods and services. In the US economy, there was $3.8 trillion in 2019 that is considered M1. And in fact, if you look at it today, it's even higher. What is M1? M1 is currency, demand deposits, what we talked about before, and these funny things called traveler's checks. If this was class, I'd often ask people if they've seen a traveler's check. Most people have not. It would be rare if you've seen one. They're kind of, let me try to explain. There's a kind of maybe old school debit cards before there were debit cards. So they kind of work like debit cards, but you would take them usually when you traveled. And what you would do is you would take them, you would go to the bank and you would get a traveler's check. And that check would be usable as you traveled throughout the country. And why you took a traveler's check rather than currency was because if you lost your traveler's check, you could go to the bank, cancel them, and get your money back. If you take cash and you lose your cash, well, there's nothing we can do about it. Yes, Austin, that is the case. That's what I said. This number is a little small. Is I was using 2019 numbers, and we have printed an awful lot of money since 2020 and 21. So that number is right now really high. Yes, we'll talk about that actually in the next chapter, what will happen or what we predict will happen. If you go back to the beginning, we talked about we have inflation when the government prints too much money. When is too much money? Well, we're pushing that limit right now. It's kind of weird to use old numbers. That's just what I had in the slides. That's what the book used. But yes, you can go and look at the federalreserve.gov, and you can actually see what the actual M1s and M2s are today. I try to keep this somewhat current. It feels bad now. I'm a year behind, and those numbers have really exploded. But I'll update them later because I don't want to always use the real numbers. Because I'm never going to ask you on the quiz or the test what the real numbers are, because they change, right? As Austin points out, we've seen what happens to interest rates. We've seen what happens to currency in just a year, and that changes a lot. But as individuals and as citizens, we need to understand what's in each category. So when they talk about it, we go, oh, okay. Most of the time when you hear economists talk about money, we actually don't talk about M1. We actually talk about M2. Everything we really consider money. It's everything in M1 that always gets students when they do the homework is if you click it's in M2, then it must be in M1 as well. I can't tell you how many times I've gotten homework questions and say, Dr. Walsh, it says which category is it in, M1 or M2? I clicked M2, it says right here, it's a money market mutual fund. It is in M2. Well, Yes, it is an M2. But they go, what about currency? That says M1. Well, that's in M1 and it's in M2. So make sure you see that everything that's in M1 is also in M2. So the only thing that's really going to be exclusive is everything in M2. And that's savings deposits, small time deposits, which we call CDs, and money market mutual funds, which are very, very similar to a checking account. It's just, it has restrictions on it. What makes the difference between M2 and M1 is the extra money in M2 comes with restrictions. So for example, if you have a savings deposit, usually you have some restrictions on it. You can only take money out 4 times a month or whatever the restriction is. Usually with money market mutual funds, there's a limit on how much you have to take out. So we have some distinctions about M1 and M2. I just wanted to kind of let you know that there is a distinction, but in class, and what most economists talk about is M2. Actually, we talk usually about a slight variation of M2, but mostly it's M2. And that's what we talk about as economists when we talk about the money supply. So that it goes back to M2. So in the United States, who's in charge of it? I'm going to go through these pretty quickly because you can read in the book and you can read through the slides. There's not a lot of thought process to it, but we're going to talk about it. The Fed is the central bank of the United States. What the Fed does is it oversees the banking system and it regulates the quantity of money. So what the Fed does is it makes sure that the banking system in the United States is running properly. At least that's part of their goal. They are one of the regulators of the banking system. And in fact, there are, banks answer to somewhere between 7 to 8 regulators, depending on how you count. So there are lots of regulators for banks. So they are a highly regulated industry. It's always one of those funny things they talk about. No, banks are about as highly regulated as you can get. And they have lots of overseers. And one of them is the Fed. So what does the Fed do? It's really responsible for the money supply is mostly what it does. It's made up of 2 components. It's made up of the Board of Governors and 12 regional banks. So the Board of Governors, they get onto you become a Board of Governor by being appointed by the President of the United States. And you are confirmed by Congress. So there are 7 board of members, and they serve 14-year terms. Yes, I should actually. So each board of governor only actually gets 1 14-year term. So you can only be board of governors, you can only be on there for 1 full term. Now you can end up being on there longer than 1 term, because you can take over somebody else's, but you can only be appointed to 1 full 14-year term. So you can get half of somebody else's in your own if necessary. So these individuals are responsible for overseeing monetary policy in the United States. I often ask students who the chair is. Most of the time, they have seen the chair of the Federal Reserve. Okay, that is one individual most students have seen either on television or in passing by. The individual right now is a guy by the name of Jerome Powell. He was appointed in 2018. I always ask students, can you name another one? Most of the time they cannot, because you don't see them on television and you don't really know who they are. Actually, some very powerful people, we don't even know who they are. You can go to federalreserve.gov and you can look them up. They aren't hidden. It's just we don't pay much attention to them. In fact, there are only 5 members at the present moment because they resign. They don't stay usually for their full 14 years. They usually resign after a couple of years. The second part of the Federal Reserve System are 12 regional Federal Reserve banks. and they're responsible for their own little region to look after. So all Arkansas banks fall under the St. Louis Fed. So if you have a dollar bill, only on your $1 bill, you can look at your $1 bill, if you have one, and you can see what Federal Reserve Bank it came from. Part of the Federal Reserve is they print money. They actually do the physical printing of the money. So you can actually see what Federal Reserve Bank your dollar bill came from. Okay, it only counts on the one. The 20s, the 5s, the 10s do not have the marking. Only the $1 bill tells you where it came from. So as a child, I tried to collect all the letters. I can only get letters A through L. I always wanted to try to find the M dollar bill. Little did I know it did not exist. But you can always check that out. So probably some of you are pulling out your dollar bills right now and talk about that. Taylor, the answer, why they resigned without fulfilling their term. Yes, I will give you the answer to that. A board of governor makes right around $200,000 a year. So is that a good salary or a bad salary for them? The answer to that is a bad salary for them. And why is that not a good salary for them? Well, who do we want in charge of being a board of governor? And if you look at their experience, we want people who could be bank CEOs to be running the board of governors. So think about how much a bank CEO makes compared to a board of governor. And so what most people who are board of governors, and in fact, they're board of governors usually as a stepping stone. Sometimes they're kind of like internships, is they're going to use being board of governor to move on to a better job somewhere else, usually in the financial industry. Now, the chair likes to be chair because they have power and they have some kind of celebrity idea, kind of like why you're the president of the United States. The president of the United States doesn't get paid a lot, but they do have some payment in notoriety and in kind of acceptance. Most people who are US presidents make a whole lot more money after they're presidents than when they were actually presidents, because they get paid to go give speeches. They'll make more in speeches after they're president than they did as presidents. So it's kind of one of those things that being a board of governors is actually what they use as a stepping stone. Very good question. We kind of talk about the Fed's jobs. They regulate banks. We're going to focus mostly in this class on the FOMC, the Federal Open Markets Committee. That's what we're going to focus on in this class. But they do other things like regulate banks. We're just not going to spend a whole lot of time talking about that. We're going to talk about this policy. So what is the Federal Open Markets Committee? It is made up of all 7 members, if there's 7, and 5 of the 12 regional bank presidents. So what the FOMC does is every 6 weeks, what they do is they hold a meeting. So at this meeting, they discuss monetary policy, and they discuss how the US economy is doing. And so what they do is they get together and talk about the US economy. All 12 regional bank presidents are there to talk about what's happening in their region. So they all get together for a day and a half, and they discuss the US economy. And at the end of this meeting, 12 people get a vote. The 7 board of governors and 5 of the regional bank presidents. Really, it should be 4 in New York City. So the New York Fed president always gets to vote. And the other 11 rotate so 4 of the other 11 rotate One of them is always stationary. It's always the New York Fed. Why the New York Fed? Well, if you had to think about the financial capital in the United States, you probably would think of New York City. So since they represent the New York City, or they represent Wall Street, the New York Fed always votes. And if you take money and banking in a later class, they'll talk exactly why the New York president always votes. There's more than just it's the financial capital. They have more goings on than that. They're more responsible for open market operations, so they have a little more power there. But for class, all we need to think about is financial capital, so New York always gets to vote, and then the other four rotate. I will never ask you which four are voting right now, because that changes every year, and that's irrelevant for you to know, at least in a principles class. Now, if you go out and you're in the banking world, you might care more about that. In a principles of econ class, we don't care. We just need to know who's there. And we kind of need to have an idea of how this decision is being made. So yes, so there are four bank presidents that vote, and the New York City, or sorry, the New York one, as well as the 7 Board of Governors. What they decide is they decide something called open market operations. And what open market operations are what they do is they buy U.S. government bonds or they sell bonds. When they buy U.S. government bonds to increase the money supply, this is what they report as lowering the interest rate. And when they sell U.S. government bonds, this is what they talk about by raising the interest rate. The Fed doesn't actually lower or raise the interest rate. What it actually does is it buys U.S. bonds or sells U.S. bonds. And when it does that, it causes interest rates to change. So let's kind of talk about the U.S. banking system. We have something called a fractional reserve system. What do I mean by a fractional reserve system? That means banks only keep a fraction of deposits. So if all of us were to go to the bank to get our money out, they don't have all of our money. They only keep a fraction of our reserves. And what they do with the rest of our money is that's how they make loans. That's their intermediary part. So they take money from savers and they give it to investors. And they can do that because we have a fractional reserve system. What the Fed does is it sets this reserve requirement. We would call this the reserve ratio. So what the Fed does is it says to banks, you are required to keep X percentage of your deposits. So if you get $10,000, then you're required to keep, say, 5% of it. So if I'm a bank and somebody gives me $10,000, I'm required to keep 5% of that, so I'm required to keep $500. So they will have $500 in cash. What do they do with the other $9,500? They loan it out. Banks can keep more than $500, but this is the required amount. So the reserve ratio tells us what's the required. So let's take an example here. So what we do is we use something in accounting called a T account. If you haven't taken accounting, it's very simple. All of the T account does is everything on the asset side must equal the liability side. So an asset is what a bank has. A liability is what a bank owes. Now, that's poor accounting definition. No, Francisco, that's not quite the FDIC. The FDIC is really insurance. So that's actually a different story. The FDIC is a different entity. I remember I told you that banks have like 7 people regulating them. The FDIC is a different regulator. It's not actually associated with the Federal Reserve. So what the Federal Reserve does is it says, if you have this deposits, you're required to keep 10%. So you have $10 in reserves. And what you do with those other reserves is you can lend the money out. So I have $100. I have to keep by law $10, but I can loan out 90. So this is what a bank would do. So we look at liabilities. This is what banks owe. So deposits, this is what they owe me. So when I give my money to a bank, the bank owes me money. So that's called a liability. And assets are how the banks make money. So they're going to look to try to make money through reserves and loans. Oops, wrong color. So let's look at how the money supply is altered by banks. So banks have a role in the money supply. So let's take an example here. So we have $1,000 in currency. How is it affected by each individual bank? So how does each bank play a role here? So if I have $1,000 currency and we don't have a bank, how much money is there? So what is M2 or what is M1? Okay, or we're just going to call it what is the money supply? Well, I have $1,000 in currency. There is no bank, so I can't put my money anywhere. So there is always $1,000 in currency. What would happen if there is a bank, though, and the bank's required to keep all of my money? So if all of the money gets deposited into the bank, well, the bank has to hold it all, so the money supply is still $1,000. What happens with the fractional reserve system? So the first 2 questions are easy. Right? We can figure these 2 out with no problem. C is where we become tricky. So here's very simple, A, here's B. Now what about C? So C is I keep $1,000. Of 1,000, I'm required to keep 20%. So I have 20% kept at my bank, and I have $800 that I lent out. So what happened to the money supply? Well, the money supply is increased because there was this $1,000 I have in deposits, right? That's part of M1, right? Demand deposits. And I put out $800 more in currency. So I took this $1,000 you gave me in deposits, and it also now is in currency. So what happens is we add them together. So what the banks create is the banks actually have the power to create money. That's exactly correct, Anna. That's not to put it poorly, that's to put it correctly. That banks do have this power to create money. So that's why when we talk about economists, we never talk about actual money making a difference. Money doesn't make us wealthy. It's what our money represents in goods and services. So when we have a fractional banking system, the banks have this power to create money. But remember, and we talked about it, even though they can create money, that doesn't make us richer. It's one of the hardest parts for students to quite understand is money is not equivalent with wealth. Wealth is what goods and services my money represents. So if we're all millionaires, that might not mean anything. Is because what we really care about is what does our money buy? Because money doesn't make us happy. It's what the goods and services that our money represents is what gets us happiness or what gets us wealth. So I could be a millionaire. In fact, I am. In fact, I'm a trillionaire. To tell you the truth. I have $1 trillion Zimbabwe dollars. So I am by definition a trillionaire. Okay, so I am a trillionaire. You know how much that money gets me in Zimbabwe? That gets me worth about 25 cents worth of goods and services if I were to convert it to US dollars. So I would get about a candy bar with my trillion of Zimbabwe dollars. So I am a Zimbabwe trillionaire, but that means I'm worth a candy bar. In fact, it cost me more to buy the money than the money was actually worth. It's one of the props I use in class. So you can go online, you can become a trillionaire in Zimbabwe too. And in fact, it costs you more to become a trillionaire than that $1 trillion is actually worth. So when we talk about money, just remember it's a means to purchase goods and services. It is not equivalent to wealth. So let's continue our part 2. And so I gave this money to Isabella. And now Isabella deposited it at another bank so we can look at this. So what's this bank going to do with Isabella's money? Well, right now when it takes the 800, it puts it all in reserves. Then what it does is it looks to find people to lend the money out to. So it finds Kareem, and what it does is it has to keep 20%, so it keeps 160, and it loans out 640. So now I have $1,000 at First National, $800 in deposits at Second National, and I have $640 in currency back out. So what does Kareem do? He does the same thing. He deposits at Third National Bank. And what do? The same thing as always. They keep 20%, loan out the money. So this process continues and continues onward. When does it stop? Well, it stops when the banks can no longer make loans. So it stops when we reach a limit, and that the limit is that all the banks have are required reserves. All the banks don't hold any money besides required reserves and loans. So this process continues. How did I know it stops at 5,000? Well, very simple. I take the original money and I multiply it by the money multiplier. And the money multiplier is simply 1 over the reserve ratio. So the reserve ratio is 20%. So 1 over 20%, 1 over 0.2 is equivalent to 5. So I take my original deposit times 5, and I see we can create $5,000 in money. So we can talk about not only can the bank create money, it creates money very quickly. So the banking system has this power to create and actually can destroy money as well. So when I pay money back for my loans, it actually can destroy money as well. So we have the reserve requirement. So we talk about that this is set by the Federal Reserve. So if the Federal Reserve wants there to be more money in the economy, how do they do that? Well, they can lower the reserve requirement and when I lower the reserve requirement, I get an increase in money. Well, because think about it, if now this instead of being 20%, it's 10%. So 1 over 10% is 10. So from before, instead of it being 5,000, it would be 10,000. So here it talks about the higher the reserve ratio, the smaller the money multiplier. And the opposite is true as well. The lower the reserve requirement, the higher the money multiplier. So we're going to give another example here of finding money. Hakeem finds $50 in his couch. He deposits the bill in his checking account. What is the maximum amount the money supply could increase? What is the minimum? And how would your answers change if we changed from 10% to 5%. So let's go through and answer these. So for the first one, he finds $50 in the couch. So if the banks hold no excess reserves, one, money multiplier times his $50 would give us a $500 in deposits. However, since there was currency available already, since we can't recount this money again, we end up increasing the money supply by $450. If that was the only $50 in the economy, then the total money supply would be $500. And we increased it by 50 by Hakeem actually depositing that in the bank. What's the minimum increase in the money supply? 0. Chase doesn't have to make a loan. They are not required by law to make loans. So just because you deposit money in a bank doesn't mean they have to loan it out. Now they do because they want to make money, but they don't want to give loans to everyone because they don't make money if the loans aren't paid back. So Chase might say, well, you gave us this $50, but I can't find anyone to give $50 to. So they keep the money. And when they do this, it doesn't influence the supply of money. So the Fed does have this power to change the reserve requirement. But just because they change the reserve requirement doesn't always mean it has an influence on the money supply. Because they have to work in conjunction with the banks. They aren't an all-powerful institution. They have to work with the banks to increase the money supply. So here's what would happen if we went to 5%. Well, instead of it being 10 times 50, it's 20 times 50, which is 1,000, minus my original deposits, and we increase the money supply by 950. However, the bank still kept all the money. It still would, the minimum amount would be 0. So remember, the banks still have the power to increase the money supply. The Fed can try, but the Fed actually does not have the power to. It really only influences the money supply would be the correct way to do that. And it does it through a couple of mechanisms. We talked about one is a reserve requirement. The other we talked about is open market operations. So what it does is it can change it through the reserve requirement or the quantity of reserves. How does it change the quantity of reserves? Through the open market operations process. So if we go back to this bank, my bank, not really a good bank. So we go back to Third National Bank. How does the Fed push money into reserves? Well, remember what the Federal Reserve buys. It buys and sells bonds. And if we remember, bonds are necessarily loans. So any money that the banks loan to the U.S. government, the Federal Reserve can buy. So what it does is when it buys these bonds, so remember, right, we have assets and liabilities. So you have reserves and you have bonds or loans. You have your deposits. So what the bank does is it takes these bonds and sells them to the U.S. government. So it could sell $1,000 worth of bonds. And what does the U.S. government send? Well, it sends $1,000 in reserves. So then what does the bank do with these reserves? Well, it goes back and it makes more loans and it increases the money supply. So remember that the loans, if they're all the way back in the bank, are all taken account for in this deposits. So when they give the money to the Federal Reserve takes these bonds and gives them cash, or gives them more deposits. I'm sorry, gives them more reserves. With more reserves, the Fed goes out and buys, the banks take the Fed's money and go out and make more loans, which creates more deposits. which causes the money supply to continuously increase. Another way the Fed increases or can increase the money supply is it can actually loan money to the banks directly. And this is done through something called a discount rate. So the Fed can loan money to the banks, and it does this by increasing the reserves in the banking system. So if the banks want to borrow money, they think they have this great idea for new loans. They have this company that's come to them and say, hey, we'd like to build a new factory in your town, and we want to borrow $2 million. The bank looks at its balance sheet and goes, we don't have $2 million in reserves. But I can go to the Federal Reserve and we can go and borrow money there. So the bank would go and it would borrow $2 million from the Fed at the discount rate, and then it would take that $2 million and it would loan it out to the company that wanted to borrow it at, of course, a higher rate than the discount rate because the bank's going to make money. So what the bank does is it goes and it borrows from the Federal Reserve. And when it does that, with a lower interest rate, it encourages banks to borrow more. And what it does is it increases the quantity of reserves. So the banks have played around with this idea, the discount rate. And we're not going to talk about it, but in 2007 and 2010, instead of just setting an interest rate and letting the banks borrow as much money against that interest rate, it did it the other way around. It set the amount of reserves, and it forced the banks to bid an interest rate for those reserves. So remember that the Fed is also a bank, and it makes money like other banks by lending out money, and it lends out money to banks. So the Fed is actually a very profitable institution because it does lend money to banks. It does help financial institutions when they're in trouble. A lot of times it really doesn't use the discount rate. We have the discount rate, it doesn't use it a lot because banks usually don't borrow from the Fed. Usually they borrow from other banks. So a bank can borrow from other banks. And the other banks usually charge a lower interest rate than the Fed. So they really only go to the Fed when they're in trouble. So I oftentimes talk about the Federal Reserve as really mom and dad. They're always there for you when you need them usually, but nobody really wants to go there to borrow money because they come with higher strings attached. Usually you want to borrow money from a bank, they have less strings attached. And the Federal Reserve is just like that. If you borrow from them, they have a lot more say and they charge you a lot more than a normal bank. And in 2008, 2009, the Fed provided millions in dollars of loans, as well as it was buying government bonds. So it was increasing the money supply at really high rates in 2008 and 2009. We've talked about they set the reserve requirements. What they've also done since 2008 is when banks hold reserves, they hold them at the Fed. And so what the Fed has done is it's charged an interest rate to this. And so each time the bank holds money at the Fed, it gets paid in, well, there's an interest rate associated with those reserves. So whether you hold excess reserves or required reserves, you hold them at the Fed. And the Fed now has an interest rate on these reserves. And sometimes you will hear this discussion of negative interest rates. You're thinking, how can I have a negative interest rate? Well, because banks are required to keep money at the Federal Reserve. The Federal Reserve can charge them a negative interest rate so that the banks actually lose money by holding it at the Fed. And So there was this discussion earlier, Austin, you talked about interest rates and why it's hard for them to be lowered. This is how the Fed has decided they can lower the interest rate. So yes, before the Fed would pay interest to the bank, it's relatively small. Well, it's about what you make in your checking account. The banks get about the same from the Fed. But they did this so that allows them to possibly go negative. So that's a way for the Fed to actually try to lower the interest rate by actually forcing banks to pay the Federal Reserve for the privilege of holding money at the Federal Reserve. So kind of a side note to this, because banks are required to hold reserves at the Federal Reserve Bank, that is why there is such thing as a $1 million bill. Well, before computers existed, if a bank had to give their reserves to the Federal Reserve Bank, they would have to somehow get there, and they would drive to the Federal Reserve Bank with their millions of dollars. But if you ever had to try to carry millions of dollars of ones, fives, tens, and 20s, that would become relatively heavy. It would make them prone to be robbed. So what the Federal Reserve did is it created dollar bills that are above 100. And what these bills did is it allowed banks to transfer money from one institution to another. So that's where these bills above 100 exist. Now, if you have $1 million bill, that means you stole it because it is not in circulation. Only a bank can have $1 million bill. And in fact, they no longer need them anymore with the advent of computers. So it's, I guess, possible now for you to have $1 million bill, but it's now more a collectible than it is actually $1 million. Well, actually, it's still $1 million, but nobody has it because it's not really usable. So that's why if you go, usually these Federal Reserve museums, they'll show you dollar bills worth $1 million. And that's why you've never seen them. They only exist in the Federal Reserve System. So what's some of the issues with controlling the money supply? One, the Fed can't tell you how much money you have to hold. They can't tell you how much you have to put in the bank. So if you want to hold cash, you are more than welcome to hold cash. And two, it can't tell banks how much to lend. It can try to influence or compensate my behavior, but it can't control it. So kind of back to this FDIC, why do we have FDIC? One of the issues with the Federal Reserve is that people only hold a fractional reserve system. And what that means is that the banks don't have enough to pay off all depositors. And if we go to the bank, and they call it bank runs, and we ran to the bank to get our money out, the bank doesn't have all of our money. And in fact, we can force a bank to close if we all ran to get our money out of it. So if people don't like the banking system, they can actually cause a bank to close if they have enough people run to the bank and get their money out. And when you do that, the bank actually has to shut down. It's been run. So a bank run actually causes banks to have to shut down. So banks sometimes will hold excess reserves depending on the situation, but they will always have to hold some reserves to satisfy deposits. And why don't we run banks? I'm telling you right now, they don't have all of your money. Well, because that's where the insurance company comes into play. That's what the FDIC does. So what it does is say, well, if you cause a bank, funny enough, if a bank closes and they have your deposits, they have to buy insurance, which means that this insurance company will pay you your deposits. So now you can hold up to $250,000 in cash in a bank, and you can get all of your money back, up to $250,000. So if the bank goes under, you don't lose your money. Previously, you lost your money, but now banks are required to buy insurance. And you know a bank has bought insurance because you see these letters. That means your money's insured because the bank paid for it. So when the bank takes your deposit, it has to give a little bit of that money out of the bank's profits to the FDIC. So the FDIC has insurance for your money. So that way, if the bank fails, it goes to this corporation, because that's what the C stands for, and this corporation gives individuals their money back from the banks. So it's not really a corporation, but it's set up like one, is that they have a CEO. Actually, it's a government office. It's another person appointed by the president, confirmed by Congress. But the FDIC oversees bank runs. They were very popular around the Great Depression. In fact, that was one of the causes of the Great Depression, because the money supply shrank so severely. We have seen a bank run recently. Well, shoot, recently, now 14 years ago. And that was Washington Mutual got ran. Most of you are too young to have listened to WAMU commercials. That used to be what they were called. They used to run commercials talking about them, but they were actually ran in 2007. They were the last real bank run we've seen in the United States. They have to, because if they don't have any reserves, Galib, if you went to get your money out of the bank, they would have none. So that is part of the process. Is we still want money from the bank, because I go to the ATM, I still want cash, and the bank has to have those in reserves. So yes, there are riskier banks who attempt to live on the required reserve margin. Is if all I do is get to the required reserves. Yes, Austin, there is some discussion if they're big enough, can they get bailed out? That is another issue as well. It's because remember, they have this incentive to make loans, and they have incentive to be at the required reserves. So what happened is they made a lot of loans trying to make a lot of money, because that's how banks make money. And if they make bad loans, then what happens is the banks don't have enough money to pay back their depositors. And in fact, the problem with if they have too much money is that the FDIC can actually go bankrupt. Because remember, the FDIC works like a company, and they collect my insurance money. So if it's insurance money, and the insurance company doesn't have enough deductibles, they can actually run out of money too, so they can't pay it. So that's what they were worried about, why they bailed them out. Yes, Austin, they can try to do that as well. As long as they do it legitimately, they try to sell those bonds off. Correct. Now, as long as it was done on the honest side, we can do that. So that kind of works, and there's a lot to that of the recession in 2008. There was a lot of behavior by banks because we incentivize them, because we have a lot of cushions for them with the FDIC and the government helping them out, that they were taking big chances. Because if I take a big chance, I get all the money, and if I fail, then I believe the government will help me out. So we have a worry of that. That's what they call too big to fail. And so we have to try to find a way, the government, since they're already involved in the market, how to be more involved in the market to make it work better. And sometimes we talk about the government doesn't always help markets, because sometimes the more they get involved, the tougher it is. Any questions about chapter 16? I know I went through it pretty quickly, but please spend some time and read the chapter. When you work the homework, work through the numbers. I didn't have enough time to go over more banking numbers that I'd like to, but please spend some time and work the banking numbers. It will help tremendously.